Good evening, everyone. This is Adrian Day, one of your co-hosts of the On the Moves webinar. Um, let me introduce Rich Checkan. My privilege to introduce Rich. Most of you know him, but for those who don't, he's a COO and president of Asset Strategies International. I've known him for probably 35 years, 30 years anyway, and I knew his uncle. I've known his uncle, who's the CEO, for even longer. So later on in the broadcast, Rich will tell you a little bit about his firm. We don't want to get too much into that right now. But right now, it's just my privilege to kick the webinar off and introduce Rich.
All right. Well, thanks, Adrian. And likewise, right back at you. Privileged to be able to introduce you. I think everybody knows you as well, but you're our go-to guy when it comes to basically resource stocks and overseas stocks and asset management. You run Feeder Shift's Europac Gold Fund. You've got your own asset management firm, Adrian Day Asset Management, and you've written books. You're widely sought after for your opinion. And as you give them tonight, everybody will understand why you're widely sought after for your opinion. And The person we're introducing here is no stranger to our webinar series. It's the third time Brian's been on the On the Move webinar dating back to, I think, 2019. So Brien Lundin, he's the CEO and president of Jefferson Financial. They put out the Gold newsletter. He's been the publisher and editor of that for many, many years. And he's also the host of the New Orleans Investment Conference. And we all just got back from the 51st edition of the granddaddy of all investment conferences. And Brian, welcome to the show.
Thank you, Rich. That introduction of both you and me just reminds me how freaking old we are all getting now. I
That
mean,
is a fact.
I don't know how long I've known you, Rich, but it's at least a couple decades.
Yeah.
And I remember the day I met Adrian, although he doesn't remember me because I wasn't that memorable at the time, but it was my first or second year working for Jim Blanchard that had a meeting with him at our New Orleans conference. And so that would put it at about 38 or 39 years since I met him. So yeah, we've been around a while, haven't we? Seen a
There's,
lot.
there's no question. And I just want to throw one thing out here for people that don't understand the New Orleans Investment Conference and why it's so important to us. I just want to share this. I think Adrian probably can chime in as well. So, Jim Blanchard started it in the 70s. It was the start of the hard money grassroots movement to legalize gold in the US in the 70s. And I mean, Jim used to fly airplanes over the White House. You can't do it now, saying legalize gold. He was the tip of the spear for the hard money movement dating back to the 70s. And Brian picked that up and has run with it ever since. If you've got anything to do with precious metals, natural resources, I don't care if you're a dealer, a miner, an analyst, or what have you, you've got to go to that conference every year. My God, it's where you pay homage to the fact that we can own gold in America. And right now, thank God, huh?
Yeah,
Yeah.
it's really coming into play, and I think that we can get into that, but I think that's the fundamental reason that gold has been rising. Everything that we've been talking about for many years, and using a lot of apparently unnecessary words to describe it, because now Wall Street has latched onto the idea and slapped a label on it, calling it the debasement trade, which
Hmm.
is brilliant. I mean, why didn't I think of this so long ago? And so it's catching, the imagination of investors out there. So that's why, the fact that we can protect ourselves, that gold has always protected against currency debasement and currency depreciation of purchasing power. Um, that's what gold does, and that's why it's so important that we can own gold.
Yeah, no
Yeah.
question. So, Adrian, you want to add to that, or?
Well, I mean, do we want to jump right into gold and silver now since
I was just gonna say, well, why is gold fulfilling that role right now? What's going on? Obviously, we just opened the government back up again. I'm sure everybody noticed the big change in their day to day with the moment the government opened back up again. But the government is open, so a little less dysfunction than we had a few weeks ago. What all's going on in your mind, Brian, that's triggering this, I guess, epiphany that everybody's having that, hey, maybe gold is something I ought to have in a portfolio?
Well, if you look at the latest rally, it really started with Powell's Jackson Hole speech when he essentially conceded a quarter point rate cut. That was the starting gun, and gold started rising. Then we had some dour employment data came in to indicate somewhat of an economic slowdown and the possibility of two, maybe three more rate cuts under the Powell Fed. Market started to price that in, and it priced it in by uh, bidding up all risk assets, but by primarily gold. Gold was the primary beneficiary, and finally silver, and finally mining stocks along the way as the Western investors started to get in. And I think the market then began to look a little further down the road and began discounting the fact that Trump's Fed chairman was coming in May, and we might have another four or five rate cuts before that happened. And when that person got in, you know good and well what he or she is going to do. They're going to cut like mad. So the market essentially started to price in a multi-year rate cutting cycle, which is really necessary. And they can fight inflation or they can fight an economic slowdown. But the fact of the matter is that the debts have grown so large, primarily sovereign debts, and in the US, the federal debt has grown so large that we cannot have normalized interest rates, normal being 5 or 6%. And in fact, I've argued that we can't have interest rates above the rate of inflation, that the currency has to deflate away or depreciate the debt at a faster rate than you're paying interest on that debt. Otherwise, the debt just keeps growing exponentially, and you get caught into a debt spiral that even the nation issuing the world's reserve currency, at some point the numbers matter. So I think that's what the markets, the investors, Western investors coming in are trying to discount and price in. And they're calling it the debasement trade, which is a great way to say it. It says it all.
Well, Brian, you focused a lot on the Fed and the Western investor, but of course, gold has been going up for 3 years now. And initially, or really since 2015, but particularly since the last 3 years. And initially, that really, to me at any rate, seemed to have very little to do with Western investors,
Yeah.
particularly with North American investors. But you're not discounting that, are you? You're not discounting what the rest.
No, no, not discounting it at all. In fact, this is in the long history of gold as an investable asset, which only goes back to 1974. But but in that long history, we've only had, by my count, four bull markets, counting this one. Some people slice and dice it different ways. But this bull market is unique. We've never seen anything like this before because it was launched and propelled for much of its relatively short life so far by central bank buying. And that's been an incredible boon to investors because it's taken out the greatest risk in investing in metals and mining. Is there going to be a bull market? So the central banks launched gold. They carried it much of the way it's come so far without the participation of Western investors and with the typical levers being mining stocks and silver lagging and just sitting in the backwaters while gold has surged ahead. So it's a remarkable opportunity that you have a confirmed secular, long-term major bull market in gold, and yet you have the opportunity to go back and buy these typical levers at long-term low levels. So it's been an incredible opportunity. I've called it a generational opportunity, but in fact, it's the only such opportunity we've ever really had in gold and the associated investments.
Yeah,
What do you think? Sorry, go on.
no, go ahead, Adrian.
I was just going to say, you mentioned the opportunity. Do you think the correction that we had starting at the third weekend of October, do you think that's over now?
I don't know that it's over, but it's ending. Right before we got on this call, I checked a few of my charts that I follow. I'm not a big technical analyst, but there are a few things I found that tend to work over the years. And one is the Bollinger Bands, which are typically, well, they're not always a good valuation or a good timing mechanism. They measure momentum in a an asset, but in this market they have been a very good timing indicator. In that when the bands have pinched, when that width of the Bollinger Bands have dropped to a low level, that's indicated waning momentum. I'm sorry, waning volatility. And in this market, waning volatility has functioned essentially as a correction. It's been the market working off the overbought status through time rather than price because we've had that central bank buying relentlessly under the market. So anyway, that those bands are pinching right now. They haven't reached the distance, the width that has indicated a rally in the past during this bull market, but they're starting to get close. So just, wet finger in the wind kind of a judgment, I would say within a couple of weeks, it'll probably be over. And it's remarkable, again, this bull market, because of central bank buying, we've only had two so-called corrections, and each of those have only been a 10% drawdown in the market. And the first one was when Trump was elected, and there was fears of that they were going to replace the gold reserve with a Bitcoin reserve. So that sent the market into a tizzy. We lost 10%, bounced right back up. In this case, it was really, I think, a function of the Western investors. And when you gain $400, $500, $600 on the price of gold in a couple of weeks, yeah, that's getting fairly overbought, and it was bound to trip over itself.
Yeah. So, Brian, I know you're hitting on the central banks, and I think this is such a big point. I mean, we've been screaming at the top of our lungs to our clients for about 4 years now, that the central banks are buying. You should follow their lead. You know, let's face it, they're not the ones who overspent in any of these fiat currency, regimes where they're having issues with debt. But they were the ones that had to deal with the problem by expanding their money supplies, right? And they've all done it.
Yeah.
So I maintain that, the central banks know better than anyone else what the problem is because they created it, right? So if they're buying gold hand over fist, my God, we should be too. We should be following that example. And we've been screaming about that for a long time. I'm a firm believer that this bull market had a head start from every other bull market in history, because none of them, to my knowledge, started with this kind of feverish central bank buying that gives it support. As you said, it kind of takes away the question, will there be a bull market? There is one, and it's continuing to be supported. We're going to see almost another 1,000 metric tons this year. And let's face it, they did that 4 years ago when gold was half the price, right? And now they're still going to buy about the same amount of metric tons this year. That's incredible demand from central banks. And if you're not in this, you got to get in it. Am I
I,
wrong?
no, and I think you raise you referred to a very important point there. The central bank buying is to a very large extent price inelastic. I mean, they might pause, but they're not trying to pick a great price, to buy gold. They're just accumulating gold because they want gold. And so that I think that's one of the reasons why the declines have been so shallow. And I think you're absolutely right, Brian, that the trading in a narrow range for a period of time, as we saw from April to August, that's kind of a gold correction. We don't get a lot more than that. But yes, do you think there's going to be a trigger that will make gold move meaningfully higher in the next move up?
Other than
Yeah,
this webinar. Other than this webinar.
other than this webinar, yeah. In my long history of your webinars, I think that we have moved the gold price. So let's just keep doing it. Yeah, I think there's a few things to talk about there. One, there are a lot of artifacts of the central bank buying that I
Freezing
find
up a little bit.
really, really fascinating.
Are we coming
It
back?
rests not only on, well, it rests on two pillars. One being uh, insulation from the dollar hegemony. And, that started when Russia invaded Ukraine and we instituted those severe sanctions on Russia. Even our allies realized that that weapon could someday be turned on themselves. So they decided to try and seek some safety in gold. The other thing is, frankly, the debasement trade. The central banks, see that it's been their job to monetize the debt, and therefore they see what's coming. So they know that there's going to be a significant depreciation ahead. But what was your last question, Adrian? I got off on a tangent. Oh, a trigger for
Yeah.
it all. Yeah, I think now that we have the Western investors involved and excited, I think the trigger is going to be the next signal because Western investors and speculators around the world, since 2008, they've only really been concerned with Fed policy. Over the last couple of years, it's been a little bit of tariffs and the like that has taken their eye off their focus off that issue. But they've primarily been worried about reading the tea leaves on the Fed. So any indication that the Fed is going to cut rates, cut a couple more times, I think will launch gold. Regardless, as we near May and we near Trump's installation of a new Fed chairman, that will support gold. And we had last week, or yeah, I think it was last week that Raphael Bostic, the Atlanta Fed president, announced his resignation in February. That's another seat for Trump. So he may get effective control um, somehow, some way, well before May.
Well, is Bostic on the Open Market Committee?
I,
I mean, he's a governor.
that's a good argument. I'm not sure whether he
Yeah,
was.
I don't.
Good
I
point.
mean, I don't think he is.
Yeah.
But um. By the way, we lost you, Rich, as you know,
Yeah,
for
I'm surprised the webinar kept going, but I'm so glad it did. I lost internet here, and I had to
Wow.
get
You should move to Puerto
reestablished.
Rico. We have good
Oh
internet.
my gosh, yeah, in Maryland, we're not doing too well. So I'm glad it
You
kept going.
assume it kept going. We might have been talking to ourselves and made just brilliant points there that are lost forever.
Well,
Yeah.
I'll just concur with everything you said, and we'll just pick it up from here.
Yeah.
There you go.
One thing I did want to, if I may, to the audience, don't forget to send your questions in. We normally take most of the questions at the end of the session, but Rich is monitoring it, and if you ask a question relating to something we're talking about, he'll bring it up, during the session. So please send your questions in. Yeah, what were you? Yeah, we were talking about triggers and sometimes I think you just don't have to have a trigger. You just get exhaustion of buyers or exhaustion of sellers. I mean, I think that's what happened at the end of October. I don't think there was a particular trigger that made gold correct. I think there was a growing sense that gold had moved in September, October. Gold had moved too far, too fast. And so people who were thinking of buying gold just said, well, let's just stand aside for the time being. And I think you can have the same thing on the downside. There's a point where you've run out of people who want to sell at this price. And so it just moves back up.
And it doesn't take much of a shift in sentiment for across the broad markets to really make a difference in gold. There's oceans of liquidity sloshing around the world trying to find the next hot asset, the next big thing. What are people talking about? It's gone into AI, it's gone into Mag 7. We don't need all of that we don't need gold to become the next Mag 7 or AI or Bitcoin or anything like that. We just need to have a few ladlefuls of that liquidity into this market is all it takes to really send it going. So even this week we saw, and over the past 5 or 6 trading days, we've seen enormous volatility in the US stock market. And some days, the U.S. stocks were down 1.5, 2%, and gold was may have lost a bit, but relatively performed better. And some days it actually had significant gains when stocks were really falling. So it seems like in virtually any scenario going forward, there's a valid bullish argument for gold as benefiting from that. And
Yeah.
I think there's a widespread understanding in the markets that that's the case.
Yeah.
Well, that raises, in my mind, that raises a very important question. You didn't really say it outright, but it raises a very important question, which is what could go wrong with gold? What are the possible scenarios in the next 12, 18 months that would make you change your mind on gold?
Well, there could be the discovery of a trillion-ton gold deposit in Uganda.
I
Uh,
was going to say the golden meteor hitting the Earth.
yeah, and then there's
My
the
favorite.
asteroid, which, by the way, if that golden asteroid landed on Earth, it would end the gold market, yes, but nobody would,
And the rest of our lives as well,
yeah,
and
it
the
would end
planet as we
everything
know it.
else.
Yeah.
It's hard to imagine, quite frankly. It would be something, you know, related to maybe Bitcoin over gold or something in U.S. gold reserves. It really is hard to imagine the kind of selling it would take. The central banks would essentially have to decide in unison to sell their gold and get back to the pattern that we had of the late 1990s. Um, and frankly, I think a lot of the gold buying today is replacing gold that was lost in the late 1990s when central banks were loaning their gold out and getting IOUs instead. And we don't really know if that gold was replaced.
Yeah.
Yeah, yeah.
So there are a couple questions that are kind of pertinent. I'm going to raise two of them right now. How low do you think gold and silver will go in this correction, and its approximate time frame? I think that's worth answering, as well as if gold is still in a correction phase, what do you see as the near-term floor for the gold prices, and how well will the mining majors do in this environment? We'll kind of transition us maybe a little bit to the miners as well here.
Um, yeah, I think that we're close to the end of this correction. I don't think, we may have a downdraft down that seems, we get these sell downs in gold and they seem so dramatic, but that's a function of the high prices we're at. We had a couple of weeks ago, we had a 5% sell off in gold, which we've seen a number of times over the years. But we've never seen a $250 drop in gold. And that's just where we are. These numbers are, like nothing we've ever seen before. So we may have, a $100 drop from today's levels, but that's very likely to be followed the next day by an $80 gain or $120 gain or something like that. I think we're trading sideways for a little while longer, maybe a couple weeks. And I think that's done. If there is a big market correction that creates a liquidity vacuum in the markets, then the baby's going out with the bathwater, and gold is a piggy bank that will be broken into to meet margin calls. So in a liquidity vacuum, everything gets sold off. But the markets do know that the Fed is going to come back with a rescue effort that will have to dwarf anything it's ever done before, just to get the same effect. So, the markets will pop right back upward.
And we all know where monetary easing goes, don't we? We're seeing it at $4,000 gold. I seem to think that this $4,000 level seems to be holding up pretty well, both psychologically and technically. I think silver, although more volatile, 50 is holding psychologically and technically. And I don't think this is resistance on the way up. I think that it's pretty much in the rear view mirror. We may dip below it again, but I think we're taking our stand here, kind of like the Alamo or Custer.
Yeah, yeah, I tend to agree. I mean, when we first had to drop, I had a target more like 36.50 to 37, but gold has proven to be amazingly resilient. I mean, after what, a week of declines to just under 4,000, we've held that 4,000 very well, and buying has come in. So yeah, I always hate to say it's not going to go any lower, but I tend to think that we've seen the low of this correction, and it's just a matter, as Brian said earlier, it's just a matter of timing before we move to new highs.
Yeah, I think we're trading in a range, and I think Rich, you make a good point that 4,000 seems to be a support line. one of the things that happened over the summer, just kind of in the background, was that uh, the people who've been in this sector, the gold bugs at least, became comfortable with $3,000 gold. That we were going to be trading somewhere above $3,000 gold, and that wasn't bad at all. For mining stocks all along the spectrum, from the major producers down to the exploration stocks. So we didn't really see the kind of summertime doldrum that we would have expected in the miners. And in fact, we saw widespread strength in the miners throughout the summer because $3,000 gold, that we're not going to get that two by four upside the head. That's a Southern expression, Adrian, uh, that you may not recognize, that just come out of the blue and have, Mr. Slammy come in and slam the markets down. Was going to be over $3,000. Everybody got comfortable with it. Then I think over the last month or so, what it's been 2 months now, I guess, we've grown comfortable with $4,000 gold. And that's what's happening right now. We're getting comfortable with that as a very strong support line. Um, and, we're going to start looking ahead pretty soon. I think the market in general is going to start looking ahead again pretty soon.
Yeah, yeah. And the other thing, of course, is as you said, it didn't hurt the miners, which is what you would have expected in earlier rallies, because what didn't happen this time is the costs really didn't go up that dramatically. We had a lot of focus on costs after COVID with inflation moving up and so on. But the cost increases that the miners had in 2020, 2021, 2022 were for the most part, just due to general inflation across the board. They weren't due to those very specific cost inputs that are major for the companies, like energy. You look at the cost of oil today, and then you compare it with the cost of oil in 2011, the
Yeah.
last peak in oil we had, or the commodity currencies. You look at the Canadian dollar, the Australian dollar, the South African rand, you know, they're still weak. And
Mhm.
so what that means is that the costs for miners haven't gone up, even as the price of gold has gone up. And so the margins and the cash flows have just expanded tremendously.
Yeah, it's a perfect storm. With the gold price doing what it did, they didn't need to have their costs remain constrained, but they got that. It's been
Yeah,
turbocharging a racing engine. They didn't need it, but they got it, and they could not have asked for a better scenario. And I think that investors in the metals could not have asked, and the miners could not have asked for a better scenario because again, we have a gold bull market, and it's just sitting out there waiting for us to buy the levers that traditional levers, which are silver and mining stocks, that lag behind. And they're still not really reflecting where they should be in light of
no,
where the
they're
gold
not.
price is.
Well, and the amazing thing to me is, we don't often look at downside, but the gold price could go back to where it was at the beginning of the year, under 3,000, and you would still have today the widest margins, profit margins for miners, basically of the last 50 years, other than this year, of course. You know,
Yeah,
sorry.
what was the profit margin, with gold at $2,000, their profit margin was probably most miners $600 an ounce or something like that.
Yeah,
And now it's about $2,500 an ounce or more.
yeah,
That's amazing.
yeah. I
Now,
mean,
just
essentially, a lot of mining companies have over 100% profit.
Yeah, most should have
Yeah.
well over 100% margins.
so that raises one question here from the floor from an anonymous attendee. Do you think the gold and silver stocks will take a big hit in the next big market correction along with other securities? So you're making the case that, the margins are almost bulletproof, right, at these levels, but that doesn't mean that the stocks can't fall. Am I wrong?
No, they can and they will. And again, in a liquidity vacuum, they absolutely will. But the rebound will come. They'll rebound very quickly. Now, the one caveat is if that liquidity vacuum is a result of some risk to the financial system like we saw in 2008.
Mm.
It took a while for the mining stocks to respond after that, after gold responded, because anybody who had any cash to deploy wanted the metal, didn't want any sort of paper, equities or mainstream equities or mining equities. And in fact, in that instance, that was one of the only times, if not the only time, that the mining stocks, as Adrian just mentioned, did not leverage the move in gold because oil went to $140 a barrel over that period. Even though the gold price nearly tripled, the mining stocks didn't provide any leverage. But yeah, unless there's some risk to the financial system at large, the mining stocks will in fact get sold off along with gold, silver, and everything.
Yeah, there's no question that in a liquidity crisis, a lot does depend on the kind of market
Hmm.
decline you have. But if it's a liquidity-driven event, there's no question that everything, including the gold stocks, in fact, the gold stocks tend to go down more than the rest of the market because they tend to be, thin securities. I mean, we who are wrapped up in this market, we think that $1 billion market cap is big, but compare that with Nvidia and it's tiny. So when you have a liquidity crisis, the gold stocks typically go down even faster than the broad market. But I'll push back a little bit, if I may, on 2008. And I was just trying to pull it up as you were talking, and then it sort of came over to me. So let me just pull it up so I have it. And in 2008, the gold index, as you probably know, peaked before the S&P. It actually peaked in March, but let's just say in July, it peaked before a sharp decline. And I'm guessing now, just looking at this, that looks like about 60% from July to October. It bottomed in October. But the point I would make, Brien, is that the XAU, the senior gold stocks, more than doubled before the S&P even bottomed. So they dropped further, but they bounced back much more rapidly. And of course, at the time, it was painful. No question about that. At the time, it was painful. But, they doubled before the S&P had even bottomed.
Yeah, the Western investors, I mean, they've been buying GLD all along. You can look at over the last year, the assets under management in GLD, the gold bullion ETF, have been rising. But if you look at GDX, it's really been interesting. GDX to gold ratio really took off almost exactly on August 1st. It just shot off like a rocket. And that to
Right.
me was an indication that Western investors were moving into the mining stocks because the leverage was just incredible. It went down in gold's correction. It leveraged gold to the downside. But over the last couple of weeks, it's actually been going back up, that ratio showing outperformance of the miners to the metals. But what's also interesting is over that period, and really over the last 6 months or so, there's been significant outflows from the GDX fund. So money flowing out of the GDX, yet the index keeps rising because its components are rising. That tells me, and I'd be interested in your view on this, Adrian, but that tells me that investors aren't just buying the index like, Johnny come lately, everyday retail investors or funds or the like, but they're digging down into it. They're much more actively engaged. They're picking their own stocks in the sector, and they're buying the individual names rather than the index. Uh, it's just a really it seems to be a contradiction at face value, but if you think about it, they're just not buying the index.
Yeah. Well, to me, it reflects the fact that the generalist investor is not really in the gold space yet, or has only just begun to dip his toe in.
Hmm.
So, if you think of
Not a bubble.
a dentist in Oklahoma who hears on the golf course from his buddies that gold is going up, and he calls his Charles Schwab advisor in New Jersey and says, "Why don't you buy me some gold?" And the guy knows nothing about gold. Well, he's probably going to buy the GDX, or he's probably going to buy the Charles Schwab Gold Fund. But they'll buy a fund. In my experience, and those people just are not in the sector in my view, or they're just beginning to come into the sector.
Yeah,
Gotcha.
which says we have a long way to go.
Yeah.
So I've got one other question here I want to go ahead and add. I'm with you on the gold thesis. With gold silver ratio still at around 80, is one of the best risk reward to be with those miners who produce both gold and silver, and thoughts on moving gold gains to the big silver producers.
I think the gold silver ratio is for traders, it's not a good timing mechanism. But for investors and value investors, it does show, which metal is relatively valued or undervalued, overvalued to the other. And I think silver is a great opportunity. Silver always levers gold in any kind of a long-term monetarily based bull market, which is what we're in. And if you look at we just clipped the all-time nominal record again, set the all-time nominal record at where we are today, exceeding $50, which gold or silver hit twice before. But if you look at the 1980 nominal high of $50, that's almost exactly $200 today. If you look at constant dollars as measured by the CPI. I think that silver could exceed that in this run because the situation is going to be different than the 1970s because of the industrial usages of silver. I don't think the industrial usage of silver does anything to really affect the price other than it removes supply. And I think the monetary demand for silver on the margins is what really sets its price. But if there's not any silver to be bought, that exacerbates that factor. And industrial demand over the next 5 years is going to take up every newly mined ounce of silver that there is. So
Been
it's
doing that
really
for fun.
becoming a factor. It's a factor I've discounted for many, many years, but I think it's really going to be important going forward.
That's a good
Yeah,
point.
well, I mean, that's a good point because what's a couple of things that are different about silver than gold. Number one, there are no huge stockpiles of silver. I think Saudi Arabia is probably the only central bank that's bought silver that I can think of.
Yeah, I think it was their sovereign fund. Yeah.
Yeah, but there are no large stockpiles of silver. And so, I mean, in theory, pretty much every ounce of gold that's ever been mined still exists and in theory is available to be sold at a certain price. I'll even replace the fillings in my teeth at a certain price. It'll be worth the pain of a dentist. But that's not true of silver. There just are not these huge stockpiles of silver. And even all of the stuff that came out in the 70s, grandma's silver teapot, a lot of that's been melted down. So anyway, that's number one. And of course, the other thing that's really significant is that most silver today, unlike gold and unlike 1970s, most silver today is byproduct production.
Yeah.
And so,
Price inelastic. Yeah.
and so you don't get price signals. The price signals do not get back to the producer very well. Now, obviously, if the price of silver goes up to $100, people are going to start looking for more silver and marginal silver. They're going to accelerate the development of silver mines. But most of your silver, and by most, I mean 75% of your silver today is byproduct. And again, something I've said many, many times, but the tin miner in Bolivia who gets 8% of his revenue as byproduct silver, he doesn't build a new tin mine because silver price went up. So you don't get the price signals are not reflected in higher production.
And you talk about silver stockpiles. One area that I find interesting about this aspect of this bull market that I find interesting, and Rich, I would really want to get your opinion on this, is that the Western retail investors who typically buy silver hand over fist at certain times have not only not done that in this market, but the indications I've been getting is that they're actually selling, that a lot of the old silver and gold bugs are aging out. They made the investment years ago, they had the foresight, and they look at this as being the opportunity to cash out on those investments. Is that what you're saying? Is there still more selling of silver than, and I guess gold too, than buying from American retail investors?
Yeah, there's no question. It's kind of been a signal to us that, the Western investor really wasn't in this market yet. I mean, let's face it, central banks don't buy silver for the most part. They buy gold. So the gold silver ratio, even though we had gold making new all-time highs over a 4-year period, the gold silver ratio either went up or stayed elevated above that magical 80-to-1 number. So that was an indicator that retail investors were not in this market, because when they are, they buy both gold and silver. So couple that with the fact that we've had some of these rising prices, and now you have, I'm hearing conversations from our clients like, I can't wait for the next one. So we're going to take our profits here, or we're having conversations with us, say, listen, I'm trying to simplify my estate for my heirs, right? Because they don't believe what crazy dad and mom did with gold. They just know that they have it, and the moment they pass, they're probably going to sell it. So they're selling it right now, just to make things easier, put them in a cash position and divvy it up a lot easier. So we're still seeing that. Although I got to tell you, we're starting to sell some silver. There's no question about it. And it doesn't hurt that you can sell it below spot if you're buying junk silver right now. I mean, that's just unheard of. People are paying
When you
less
say
than the,
sell it, you mean you sell,
meaning
but
I'm
others to
selling it to
buy.
clients. They're
Yeah.
paying less than the silver price to get
Yeah.
junk silver right now.
Do you have the availability?
Yep. Yeah,
Really?
because think
Wow.
of what's happening, right? So silver. All right. So I'm going to throw out some numbers here, Mr. Three-time guest. So when you first came here on our show in August of 2019, gold was $1,500 an ounce. Silver was about 16 bucks. Okay. In November of 2023, when you came back, gold was just under $2,000 an ounce. Silver was 23 bucks. Today we're sitting at what, $4,100 gold and almost 50, 51, $52 silver. There's profit potential there. And when that happens, when the price moves up significantly like that, what happens is everybody starts selling onto the market and taking their profit. So the wholesalers were buried in junk silver in the past few
Mm.
months. Everybody's coming in trying to take that profit, secure their estates for the kids or what have you. The wholesalers were absolutely buried, and there's one thing they can do that can move that silver faster than anything else, and that's drop the premium. So they're giving it away. Now, granted, they bought it at much lower prices. They're still making a good margin, but they get to sell it to me, and I get to sell it to my clients below the silver price, which is unheard of. I hadn't seen that in 30 years.
Have you got a special for us, Rich?
We do, but not on that tonight. We actually went out with one earlier in the week. We're going to do something with gold maples here tonight. So,
Oh, okay, I'll wait on that then. Okay.
So, Rich, that's all. That's a great point. But let's get back to how smart I was. Uh,
I think you
I
said buy both
really
gold
like
and
to
silver
focus
at
on.
every visit.
So
So,
when I say buy gold and silver, people should listen. And you happen to sell gold and silver. Hmm.
so, so Madeline, our
I see why
marketing
you invited me on this show.
Madeline, our marketing coordinator, said, make sure you tell folks tonight that they should go ahead and buy gold now. Don't wait for Brien to come on the show next time when it's going to be higher again.
There you go. No, you make a good point, though. Junk silver is always been my favorite way to buy silver because it is usually, at least quite often, the cheapest way to buy silver.
Yeah.
And
Yeah.
I
And
think
you
it's
get
just neat.
divisibility. I like that divisibility.
The
You don't
visibility
have to pay a premium for it. Right now, you're getting it at a discount.
and
Wow.
I know numismatists hate them and think they're ugly, but I think it's just neat to have these things that were carried around in, the 1930s and 1940s and 50s in people's pockets and they were spent.
Yeah,
Money was
yeah.
real. Yeah.
Well, can we move on
Yeah.
to the equities now? Is that
Yep.
okay?
Yes.
So, Brien, you obviously write a newsletter, gold newsletter, that talks about the equities primarily. Where are you seeing the best value now? What part of the sector are you seeing the best value?
Yeah, Adrian, I don't I don't usually pick a theme and then drill down. I take each story I hear on its face value and look at it as an individual opportunity or lack of. But I am seeing value for different reasons across the spectrum.
Mhm.
I've never really focused on the big producers over the years. I usually almost always focus on the further down the food chain where you get the potentially windfall profits from the discovery and development plays. But the majors, I think you've made the point in your writings recently that Agnico Eagle, as much as it has moved, still on a P/E basis and other classic valuation bases is at the end of its historic range at levels that as low as it's ever been. And again, we're talking tremendous margins. So I think the majors are value right now, and lower risk. Risk adjusted return in the majors is, I think, very attractive. The development plays, we had companies that were trading for under $10 an ounce in the ground for their identified resources, some of them with economics wrapped around them, some not. And that was extraordinary. And now those same companies are trading for $20 to $30 an ounce in the ground. And so they've had a 2 or 3x in terms of market valuation. Um, and we say, wow, what a move. But that is more a function of how bombed out they were before than where they are now. They're certainly not overbought or overvalued at $30 an ounce in the ground when in a normal market, these kinds of resources have sold for $150 an ounce in the ground. And by a normal market, I mean a market that isn't $4,000 an ounce. So who knows where a big strategic deposit of 5 million ounces or more that's trading for $30 an ounce in the ground, who knows what that will eventually sell for? With gold prices like we're having now, is it $1,000 an ounce? You're still going to have the percentage-wise the same kind of margin that you would have had in the old days at $150 an ounce. And even the exploration plays are trading, they were at $5 to $10 million market caps 6 months ago, and now they're at 20, 30, well, they're more like $30 million market caps or higher right now. So they've had big moves. But still, over the long term, that's not overvalued for a good exploration play that has now millions of dollars in the bank, drills turning on prospects that have been um, cheaply explored and technically very well explored over the past few years when nobody really wanted to spend a lot of money drilling. So all across the spectrum, there's just tremendous opportunities right now. And I just take each one as it comes to me and try and judge it not on whether it's going to go up in value, which is, we've been doing over the past 10 years. Is this going to go up in value? But is it going to go up in value quicker and further than most of the other companies out there?
Yeah, and I'll throw that to you as
I,
well, Adrian, because Donald was asking basically if you had a wad of cash right now, what would you prefer? The majors, the mid-sized, or the juniors? So I think Brian said case by case basis. I look at the merits. Where are you at? Do you have a favorite band?
What, as Brian said, definitely across the spectrum right now, across the spectrum. And that includes big cap miners, big cap royalty companies, the mid-tier developers, the mid-tier intermediate miners, all the way down to the exploration companies and so on. I think there's value across the board. And just to emphasize what Brian said, well, he was quoting me, but um, you look at the big cap miners today, and because the price of gold has gone up so much more than the costs have gone up, they remain undervalued even though the stock prices have doubled and more. And you mentioned Agnico. My favorite metric is price to free cash flow. That's my favorite metric.
Mhm.
Um, but what people miss sometimes is if the price of gold moves up, not only does the value of your mines go up and the value of your reserves in the ground go up, but they go up on a leverage basis. Because if you've got 100 or 50 million ounces of reserves, but the price of gold doubles, you can bring more resources into your reserves. So they go up on a leverage basis, and the same with your cash flows. The cash flows, so long as the costs stay under control, the cash flows go up on a leverage basis. And so you look at Agnico's price to cash flow, price to free cash flow today. I joke that it's nothing that would attract Ben Graham, but the price, its price to free cash flow today is higher than it was at the beginning of the year, but it is lower than it was every other quarter for the last 5 years. Now, does that make sense? But when gold is at 4,100 and when the margin of a company like Agnico is $2,000, almost 100% margin, compared with where it was 2 years ago, 3 years ago, 4 years ago, 5 years ago, does it make sense that it's trading at lower multiples? I would say absolutely, absolutely not. And so I think you can see value across the spectrum. But, Brien, you mentioned something, or you just quickly referred to it. You said, juniors are cashed up. Tell us how you see the exploration companies today, say, compared with where they were 3-4 years ago?
Yeah, the last 3 or 4 years, they've had, really good companies, good prospects. There have been some companies that have just decided not to drill, even though they had the money because the market was not rewarding success. Putting out a good drill hole was a liquidity event. It was like sticking your head out of the foxhole. All of a sudden people take shots at you, and you would lose market value. So they kind of sat on their hands, or not really sat on their hands. They did the work that should be done. They did the mapping, they did the sampling surveys, they did maybe some geophysical surveys, the kinds of things that don't move a share price and nobody's really interested in the boring stuff, but they didn't really drill. And so a lot of prospects have been out there just at the starting gates and waiting to go. And all of a sudden, the financing dam burst and money came in, and they've been drilling. And I have been amazed across the board. I was talking about this with Bob Bishop at the New Orleans conference. And he agrees. Well, he was talking about the quality of the exhibitors on our exhibit hall, and I was talking about the quality of the drill results I saw this summer coming out. On a general basis, broad basis, they were about the best I think I've ever seen. Some really extraordinary drill results. And so these prospects were just begging for a drill bit, and now they're getting it. Another really interesting thing that's happened, well, it's really two things. There's less majors now than there were in previous bull markets because of consolidation.
Yeah.
I really don't have a good handle on how we are in mid tiers, whether we have more or less, but we're going to have more mid tiers coming forward. The majors, with less majors, there's going to be fewer big takeouts at significant premiums, not because the money isn't there, but there's just, a Newmont, a Barrick, these other major companies can only absorb so many new companies or projects. So there's going to be less on the M&A front that are going to be really big deals where juniors are taking over. But at the same time, there's so much money coming in the sector, and there's generalist money coming into the sector, that a lot of these companies can actually build the mines themselves. We have had examples like Collective Mining is one of the bigger winners in our portfolio. It's pre-resource, and it did $100 million financing. $100 million financing is the new $10 million financing. It's just amazing to me. Now, it's an extraordinary project, but that's a huge financing. So the money is out there. That money did not come from within the mining sector. That money, at least a large part of it, came from without the sector. And with that kind of money out there from hedge funds, institutions, and the like that can write big checks on a thematic investment, it really changes everything. And you know well, Adrian, that the old axiom has been, if you're an explorer, don't develop your project. You don't have the expertise. You're going to screw it up. Well, you can buy the expertise at some price. And if you've got $2,500 of margin in every ounce of gold, you can make $1,000 an ounce mistake and still really just have an incredibly profitable project. So I think that's one of the things that's going to happen is companies are going to decide that they're going to position themselves as being the natural other bidder in a takeout. So they don't have to take a 10 or 20% premium. If a major wants to buy them, they're going to have to pay the big price, or like with Cisco, they're just going to go ahead and develop it themselves.
Well, I don't want to leave a wrong impression, or maybe you disagree with me, but when you were talking about mega mergers, yes, you may well be right. As we consolidate, and we have consolidated dramatically at the top end of the market. That doesn't mean that the major companies are not going to be interested in acquiring projects. They still need to acquire projects just to keep their pipelines full and to continue to meet their production targets. I mean, I think in the near term, when you have Newmont buy Newcrest, in the near term, that kind of removes Newmont from doing more acquisitions because they've got enough in their portfolio and they want to actually sell off some of the things that they bought. But I mean, over the longer term, these companies, because if you produce 4, 5, 6 million ounces a year, you've got to replace that. It's a depleting asset. You've got to replace that every single year. And you either replace it from your own pipeline or you replace it by buying things. Do you look at a company like Agnico, for example, and Agnico is one of the more active in taking stakes in exploration companies. So they are one of the more active. But 2 months ago, before they sold their big stake in Discovery, Orla. Before they sold their big stake in Orla, they had over $1 billion in investments in junior companies.
Mm-hmm.
And that was not, Amar Al-Jaundi made it very clear, this is not a hedge fund we're running. This is not an investment fund. We are only investing in juniors if we think we might want to take over the company or acquire one of their projects. So I think the seniors are still very, very active. But of course, the other side of that you mentioned was PE, private equity and hedge funds. And of course, we haven't mentioned the elephant in the room, which is Tether. So there's a lot of new interest. There's a lot of interest in gold stocks today, including juniors, from new sources of capital, which is what you mentioned, but new sources of capital. But 10 years ago, 20 years ago, 30 years ago, but if they thought about gold at all, it would have been the bigger companies. They wouldn't have been going down to the exploration companies, these companies, but they are now.
Yeah, and another interesting thing is that we're seeing companies, instead of signing joint ventures of juniors, they're taking the 9.9% equity stakes, which is interesting. They're getting that foothold, and they may be one of a few seniors that have those similar footholds, which could make for an interesting bargaining when there is a takeout. I guess the point I was making, and it depends on how you slice it and dice it, as opposed to, let's say there were 10 major mining companies 20 years ago, and now there may be 5. 10 years ago, or 20 years ago, those 10 companies might have made 5 big acquisitions over the course of a couple of years. So that's 50 takeouts. Today, if you have 5 major mining companies, they're not each going to make 10 necessarily big takeouts over the next couple of years. So on the one hand, there'll be less of the traditional takeouts, but on the other hand, there'll be other opportunities with generalist money in there, like Tether, like big hedge funds. As an example that I'm saying that you have a big gold rush in the Tudagon district in the British Columbia right now for a number of different plays and discoveries. A hedge fund that wants to take a strategic thematic play in gold and silver and say control millions and millions of ounces of gold, silver, and copper forever could say, well, I'll write a $500 million check and I'll take all those companies out. And there it goes. It just has it. It may not know what to do with it at that point, but it's made that strategic play. And that's kind of what Tether's doing. It's not been the most sophisticated move into the gold mining sector, but they're learning quickly. And they're writing big checks. So nobody really cares how sophisticated they are. They're writing the big checks.
Yeah.
I have one question here from Adrian, another Adrian Cantwell. He says, one, copper miners have run into production difficulties for various reasons in the recent past. Is there a risk of noticeable disruption in gold mining output in the next few years, or is it very predictable? And then a second question, how quickly is gold production forecast to rise in the next few years, and is it forecast to keep up with demand? Which one of you wants to jump on that?
You want to go first, Brien?
Yeah, there are a lot of issues with gold responding to those price signals. And they run the gambit. It's different um, jurisdictions, jurisdictional risk. There's when the gold price rises, countries want to renegotiate their deals with mining companies and the like. And there always seems to be something that interrupts production. And then there's the fact that it can take 10 years or so or more for a gold discovery to ever get to production. So it takes a while. So long way of saying, I don't think there'll be a very quick response. But with gold at $4,000 an ounce, there are a lot of projects on the shelf that were uneconomic, optionality plays, as it were, that could be brought into production within 3 years or so to take advantage of those kinds of gold prices. So I would say we have a good 3 years, but more reasonably, probably 5 years before we see a significant increase in gold production that has the potential to dampen the price. But there are other factors, monetary factors, that I think are going to take the price much higher.
Could you
Sure, but
repeat
the
before Adrian
demand,
goes? Can you just repeat how long these companies take to from the start to their producing? I don't think most people understand how long of a cycle this is, and I think it contributes to the boom bust mentality, right?
Yeah, it takes a long while. It can take 5 years to get a permit. In some cases, for big copper projects, it can take forever. I was looking at a chart for lead times for copper projects, a dot plot of historic plots, and one of the dots was at 40 years. So it can take an awful long time. I don't know what project that was. Uh, so it takes longer in copper because these are really big projects. But yeah, it takes about a decade from discovery to development. And if a project misses the cycle, it could take 20 years or so. The cycles are extremely important in that a lot of discoveries are made. Any discovery that was made in 2011 or 2012 missed the cycle. So they had to sit fallow for a decade before they could get developed.
Good point. Yeah. Adrian?
may I just jump in there? The first part of the question was on copper, and we're seeing problems with some of the copper mines. And is there a risk of that happening with the gold mines? I don't think so, not in the same way. And the reason is that the copper mines, as we know, tend to be much bigger than a typical gold mine by a factor. So they're much bigger, but they tend to be much longer life. And so most of the copper mines, if you look at, say, the top 10 copper mines in the world, other than, well, two of them from Robert Friedland, but other than Friedland's two recent discoveries, the one in Congo, Kaola, and oh my gosh, it's gone out of my mind now, Mongolia. But, you look at the list of copper mines, Grasberg is 40, 45 years old now. And that's one of the more recent ones. Something like four out of 10 on that list have been operating since the 19th century. The biggest one, Chuquicamata, has been operating since 1860. So the point I made, and that's completely different from gold. I mean, other than the deep South African mines, most gold mines do not last decades, right? And so you've got much bigger mines and much older mines. And it's the fact that they're so old and going so deep is what's causing the problems, or what's causing most of the problems. Obviously, Cobre Panama was a purely political situation, but if you look at the other ones that are having problems, whether it's Antamina or whether it's Grasberg, they're a function of these mines being so big and so old. And so you don't have that same dynamic in the gold market. So yes, you can have political situations, you can have mines confiscated, you can have mines closed down because of political issues, but you're not going to have you don't have the same geologic risk with a gold mine that you do with a copper mine.
All right. There are a whole bunch of questions. I don't know that we're going to get to all of them, but Adrian, I know we had a couple things because we have Brien specifically that we wanted to ask him tonight. So I want to get them out of the way, and then we can go through questions as far as we can get, if that's okay.
Sure.
So the first one was basically, after your 51st New Orleans Investment Conference, right? For this in particular this year, what was your biggest takeaway? I think that would be useful to share with everybody.
Yeah, Rich, I don't know. I mean, it was overwhelming to me. I don't know that I had one takeaway, but there were a few things that struck me. Bob Prechter always brings it with just extraordinary charts. And, I'm not sure that I am, well, I know I'm not the biggest devotee of Elliott wave analysis. I think there is some validity to it. But I don't know that it's infallible like a lot of EW analysts believe. That said, Bob brings a lot to the table in terms of relative valuations and wave analysis. And he points to stock market valuations, and he had a particular one. Adrian, you might remember it.
Yeah, I
I
do
guess
remember.
what it was a price to cape ratio or something. And he was showing a box that showed the historic distribution over decades, a century, and how everything fell within this box. Then he expanded the chart to show where it was since, what was it, since 2000 or something. And,
Yeah.
and that little box was tiny, and then the expansion, the ratios was just out in the solar system. The how far overvalued stocks are today and these days. And then he gave an Elliott Wave prediction for gold and said he predicted, as he has in the past, and has not always been right, but he predicted a big correction in gold. But he thought that that correction in gold was going to come as a result of a liquidity event, like we've been talking about, that would take the stock market down to more normal levels and would have, the baby out with the bathwater, would bring gold down in a correction, but that correction would solve a Elliott wave uh, uh, need for a correction, and then gold would go up, and he predicted that price would be somewhere over $20,000. And that is not out of the realm of possibility in my view. I think it's an outlier, but if there's some sort of a monetary reset, then I think we have to have gold somewhere over $20,000. So I thought that was interesting. I thought that Brent Johnson, who always brings incredible value, was had a great presentation that I needed to go rewatch on stable coins and how it's essentially a force multiplier or a force extension of the dollar hegemony around the world. I think that was really interesting. But the content was too much to take in, frankly, at one time, which is why our recordings are so valuable. Um, and it's a kind of content that you can just feel it. It's just rich and varied and deep. Um, And other than that, nothing that really stuck out above and beyond the overall quality of what people were saying.
Gotcha.
Yeah, I
And
mean, to
yeah,
be
go ahead,
honest with you,
Adrian.
I thought this year was one of your very best. I mean, we always like it when you have a star, whether it's Maggie Thatcher or
Yeah, you like
Tucker
it because you don't
Carlson.
write the check for that star.
No, what I'm saying is we always like it, and I think it obviously makes certain people, it attracts certain people to go to the conference. But the truth is, for people you had this year, some of them, a lot of people I say, oh, do you know Jimmy Oreo? And most people say no. My gosh, what a great talk that guy gave. And so there were just people like that, Jimmy Oreo and Jim Bianco, and the panels are great. Your panels are really good, where it's more like a discussion among people than a Q&A. Brett Johnson was great. Yeah, no, I agree with you completely.
Yeah, I got away from the big political speakers a number of years ago, and yeah, quite frankly, a big part
I
of
think
it
you
was
left that on Canal Street.
yeah, well, a big part of it was I had to write a really big check for somebody that didn't really have a big influence in whether the kind of attendee that we were marketing to or wanted to come didn't have a big influence whether they were going to come. Sure, they loved to hear them talk, but half of the audience these days, if you have a politically oriented speaker, some significant percentage of your audience is going to be really put off by that speaker. So it's a risk without much of a reward. And I began to focus on the bench strength and you have to figure out what you can bring to the table. And these people who are out on YouTube and X/Twitter and the like, who really extraordinary minds that have risen to explain the extraordinary times we're in, they get a lot of followers because of the quality of their thinking and what they're proposing and predicting. And we can bring those people to their followers in person in an atmosphere that's fun and dynamic and entertaining and energizing. And you can actually meet these people and mingle with them. So that's kind of the niche I think we fill these days. And it's, as I told people, you can find two, three, or four of our speakers at other conferences, but you're not going to find 40. And that's basically our business model is we just try to bring overwhelming value.
Understood.
Which you do.
For sure. So the follow on to that is okay. So this year, got it. What about over the decades? You've been doing this for a long time. Anything stand out over the years?
Yeah, I missed Ayn Rand, but I got to sit in with Jim on a number of speakers, big name speakers. The Dick Cheneys, the Colin Powells, the Norman Schwarzkopfs, and the like, who are always popular. One of my favorite speakers of all time was PJ O'Rourke,
Hmm.
and I was at a lunch when it was shortly after the Waco, and G. Gordon Liddy was at the lunch, sitting right next to me, explaining how they should have had one of these kill teams go in to kill all the baddies and go out the back and then bring the psychological team in to comfort everybody. And he was describing all of this. And I swear to God, I was looking at Liddy and he was standing next to me and he was so intense, I thought he had a brain vein that was going to explode all over me. And I looked across at the table at PJ O'Rourke and PJ's jaw was on the table and he was just, I could not believe what he was hearing from G. Gordon Liddy. Um, Really interesting interaction there. But the best was Margaret Thatcher. She was just unbelievable. She talked to my wife and I about her grandkids because her grandkids were about the same age as our kids at the time. And Jim Rogers kept interrupting her, and she just totally sliced him to rhetorical ribbons, uh, and, and then just resumed talking about her grandkids to us without skipping a beat. It was absolutely amazing.
Brian, was that the lunch that you didn't invite your British speaker to?
To this day, I regret that I had no influence on who was invited to that.
Okay.
Jim was totally in charge. He had Jim Rogers and Byron Ween and a bunch of Wall Street people that year. Uh,
Okay, I forgive you. I forgive you.
I showed up where I was supposed to show up for that one, Adrian. I wish I would have thought about it and had some influence up. That was probably my fault. But then, you don't even remember meeting me back in those days. So what can I say?
All right. So I've got a couple questions. We're not going to get to them all, but I think these two might be worthwhile. We can all kind of sink our teeth into it. The first one I've seen a couple of people ask about leasing gold. So you buy the gold and you lease it and you get some sort of return on your investment. And the question basically is, do you think this is a sound investment? And we all know some very good people, some really bright people that are doing this type of business. So I'm not going to talk about any specific companies, but what are your thoughts on taking metal and then leasing it out and getting a return on your metal?
My view is it better not be all or a significant percentage of the metal you have. I don't doubt the efficacy, and I don't doubt that the leasing is with reputable companies, but each lease agreement is a separate contract with a separate entity, and you have to have a good feeling that that entity is trustworthy. And any time that interest rates get really high, that's a reflection of the trustworthiness of the other party. So if you don't own it, and they'll say you still own the gold, but you just lease it, I don't see how that's possible. If you don't have the gold in your hands, you don't control it, you don't own it, and you don't have control, and you have brought counterparty risk into an asset where one of the key advantages is no counterparty risk. So basically, it depends on how much gold you have, and could you afford to take that risk to earn that return, the potential risk of something happening to it. Battle Bank's going to be getting into that, loaning against your gold, which I think is
A little
like,
bit different. So they're gonna allow
Yeah.
you to take a loan against your gold as
yeah.
collateral. But in this case, we're talking about leasing it. What are your thoughts, Adrian?
No, no, I mean, I basically agree with what both of you have said. There's a distinct difference between a battle bank program and you don't want us to name them,
I,
companies that
yeah, I, I
companies that
I
lease your
would.
gold out. I mean, to me, the company, the company that we all know, it's been an exhibitor at New Orleans as
Yeah,
leasing gold. I know nothing against them. I've not heard any complaints.
I
You
say
know,
he's one of the brightest minds in the industry.
yeah,
Yes,
the
I
guy who
would agree.
started it is very bright. I've known him a
Yeah,
long time. But I think so there's nothing negative about the company that I know. But I think
100%.
Brian's point is critical. It's a matter of how much you lease out. And if you're, if you've got a certain allocation to gold that is your hedge, your insurance, then you don't want to be playing with that. You want that in your own grubby hands or in somewhere really solid, unencumbered by anyone else's. It's an asset of no one else's liability. Now, when we get to investment gold, leasing it out and earning a return, if you want to do the work and look at each particular lease that you're offered, there's nothing wrong in that. But I would keep the insurance totally unencumbered.
Yeah, so I'm in line with both of you. The first thing I ask, why are you holding gold in the first place? If it's insurance, like you say, you don't touch it. You don't put any sort of potential risk on that. That is your wealth insurance. You want that policy to be there in place when and if you need it. So if you do identify some funds, the biggest issue I have is you got to understand why you're getting a lease payment, right? So there are firms out there, jewelers come to mind right off the bat, that need to borrow metal to be able to make it into all sorts of stuff that people will buy, that they eventually get a return on that and they can pay back, right? So they rent it, they borrow it for a period of time. It's not theirs. They have to give it back at some point in the future. But that's where the risk comes in. What if nobody buys their stuff? What if they cannot return the metal or the investment or what have you, they go belly up. So you're putting your metals at risk, and it's no negative on the companies that are offering it, like you said, Adrian. But I still think there are risks there that you've got to take into account, and if the reward is worth it, then you take that risk, just like any other investment. Does that make sense?
Mhm.
Makes
Okay.
sense to me.
And then this one's probably going to probably be our last question. Then we'll go around and have people kind of wrap up their thoughts. But uh, if I could find it, it's going to make us take sides, I think. Uh,
Hmm.
so
Those are fun.
yeah. And first off, just a comment: the dentist is not going to give you your gold back. They're going to say they misplaced it or something, is what one attendee said.
Yeah,
Uh,
neither is the Undertaker, by the way.
Yeah.
exactly. So, all right. So this is the question where we might have to divide, draw lines. Would investing in physical gold be the best investment, lowest risk right now, given the downside risk of metal securities in a liquidity crisis? For example, in the '08 GFC, gold was hit hard temporarily, but rebounded quickly. Not sure what happened with the gold and silver stocks at that time. I think, Adrian, you covered that. But the question is, right now, do you think a better investment is gold or equities in the sector?
Who's going first?
I don't know. I
You're the
can,
guest.
yeah, there you go.
Okay, well, I've always maintained there are two reasons to hold gold: insurance and investment. I wouldn't call it an investment. I think you absolutely need to hold gold as insurance against something you know is going to happen, not the kind of typical insurance against a unforeseen eventuality. You know your dollars are going to be worth a lot less in 2, 3, 5, 10 years. So you can protect those dollars from that depreciation by buying gold and silver because over decades, long sweeps of history, they've always preserved uh, purchasing power. As far as investing, it's really interesting that forget who it was. One of the big Wall Street firms came out, or one of the big spokespeople for one of the big Wall Street firms came out and said that he recommends now a 60-20-20 portfolio.
Morgan Stanley. Yeah.
60, Morgan Stanley has 60 equities, 20 bonds, and 20 gold. And that brings up a whole long discussion about the evolution of risk-adjusted return over time. For many years, this is going back to the 1990s, the the modern portfolio theory recommended a 5% allocation in gold for risk adjust to reach that efficient frontier of the highest risk adjusted return because gold was contracyclical to other assets and therefore it hedged downturns in those other assets. Since 2008, all those inverse correlations have turned into positive correlations and have trended toward one because every asset class has been lifted on a sea of central bank liquidity.
Free money.
So that's changed all the backward-looking models. And now it seems like I haven't seen any models that have gone back and actually, applied the mathematics to it in the algorithms. But it seems to me that gold's place in our portfolio has risen not because of its contracyclical nature, that it performs opposite of those other asset classes, but that it simply outperforms those other asset
Exactly.
classes. It's outperformed.
1,300% in the last 25 years. That's
Yeah,
pretty
and
good.
you can cherry pick time frames
Yeah.
and make any asset class look like the biggest winner in the world. But it is saying something when you can say that gold has outperformed every other asset class over 10, 20, 25 years. Um, and that's what it's done. So I think that's how it's earned that 20% allocation. That said, I think you can leverage those returns in gold through equities because of the mining equities, because of the unique situation we're in where they have lagged this really historic move in gold.
Gotcha. Adrian?
Yeah. Yeah, modern portfolio theory is just total nonsense. It's just absolute, it's worthless because as Brian said, it's backward looking. And
Yeah,
so all it's doing is saying over the last 10 years, if this had been your portfolio, you would have had the greatest returns at the greatest risk. Well, why don't they narrow it down more and say, if you'd have bought Origin and a Cisco, then that's the perfect model, because over the last 5 years, that really worked well. But it's meaningless for looking at the future. So anyway, I think the whole premise of modern portfolio theory is this is a family show, so I'll say
Don't
nonsense.
hold back, Adrian. Tell us what you think.
No, I don't use four-letter words on family shows.
But Adrian, don't you feel that it's particularly interesting in this day when passive investing has become such a uh, you know the thing to do and such an inherent risk in the markets when all the markets move together?
Hmm.
Sure. No, I agree with that. But to get back to Rich's question, I don't think there's going to be a big difference. I mean, I would say that if there's a difference between, as you mentioned, Brian, and we all know, there's a difference between gold as an insurance and gold as an investment. And so if you don't have your insurance gold, your hedge, then that's what you do first. You go ahead and buy that. And Rich will talk about allocations and so on and so forth. But if you don't have that, now, if you're looking at gold as an investment, I have to say, sorry, Rich, I have to say that I think the gold stocks represent a much better risk reward right now than bullion as an investment, as purely as an investment.
Because of greater
Hmm?
potential reward, right?
Yeah, absolutely. But again, if you haven't got your insurance, then that's where you start always.
So I set this up as we were going to have a big conflict, but we're not going to have any conflict at all because you know where I stand, Adrian. Gold is insurance; it always is. And yeah, it's got great returns in air bunnies over the past 25 years, but that's really just a statement on the weakening dollar. That's not really gold being that much more valuable, in my opinion. So gold is your insurance. If you're buying insurance, there's no option. You buy physical gold. If you're looking for profit, I do agree. The mining stocks are the way to go. And I think, Brian, you said this earlier, silver, right? So these are the two things that have been lagging gold. As the
Mhm.
central banks have been buying up gold because they are the potential profit generators and they are kicking in now. Both of them are. And I think both of those are real options for you if you're looking for profit. So,
Yeah.
uh, yeah, so not a lot of disagreement. I just a big puff of smoke and nothing going on. So at this point, I want to kind of make the rounds, and we'll start with our guest again first. Brian, if you want to leave everybody with just one thought, what's that going to be? And then let us know how they can get a hold of you. We're going to reinforce, by the way, all of this in a recap email that goes out to everybody tomorrow to include, and I hope Brian's going to touch on it and offer to get the tapes for the 51st annual New Orleans Investment Conference. So
Yes, we call them recordings now.
recording. Yeah, I'm just dating myself. Sorry, but
I actually have old cassette tapes in a storage unit from many years back, and it's amazing that things were turning up. John Exter criticizing Milton Friedman and the like from early 70s. Interesting stuff. But yeah, my takeaway is this is a generational opportunity. We've been handed this opportunity on a silver platter. Somehow, some way, the bull market is in effect in the metals and the traditional levers are still at long-term low levels, and it's an opportunity everyone needs to take advantage of. Uh, you can go to goldnewsletter.com or use the links that we're going to give you to subscribe to Gold Newsletter, but you can also get a free guide on investing in gold and silver and mining equities in every way you can invest in the sector. Bring yourself up to speed, get involved. The most important thing you can do is buy that insurance, gold, physical metals, then look into the more speculative areas, but get educated in those areas before you jump in. And again, the New Orleans conference recordings, they are online. You download them, listen to them on your computer as a podcast, whatever you like, but or watch the videos. But those are all available at an incredibly low price that I cannot remember right now. But it is pennies on the dollar compared to what people spent to actually be in that audience. You don't get to talk to the speakers and rub elbows with your fellow attendees. You don't get to eat the beignets. but you do get to watch the recordings or listen to the recordings and get all of the information from the conference. So people spent thousands of dollars to go to this event, and for only a couple $100, you get to get all the basic information presented to you. It's an incredible value, and you'll have the link.
Yeah, and we'll put that information in the email tomorrow. I'm sure Brian's going to send that to me overnight. So, all right, Adrian, your thoughts?
Well, first of all, I absolutely think people should get to take the whatever you call them, the
Recording.
recording. Should get the recordings to the New Orleans. There's so much information there from so many people, and honestly, Brian, the price you're charging is an absolute bargain. But so I
Thank you.
really mean
You're
that.
giving it away.
But yeah, you are basically. But I would not downplay attending it in person.
Yeah.
I mean, I think. I mean, my hope would be the people who get the downplay or whatever you call it, who get the recordings, actually it makes them want to go next year.
Yeah.
You get, in my view, you get so much more out of it by being there in person than you do sitting on the couch at home watching. So, but anyway, do get the tapes. I think they're whatever they're called. I think they're really worth doing. I agree with Brian that it's a generational opportunity in the gold and silver stocks. The one thing I would leave people with is to right size your allocation for you. Now, for me, I'm comfortable with 100% of my investments in gold stocks.
It's just because you're good at it.
Well, whatever, but I'm comfortable with that. But, you know, there's two sides to this. There's the financial risk and there's the emotional capacity to tolerate risk and volatility. Volatility, of course, is completely different from risk, but most people seem to think that volatility equals risk. It does not. Even the modern portfolio theory mathematical formula for risk is simply a formula for volatility. They're two different things. One of my pet peeves. But anyway, some people can tolerate a lot of risk and volatility financially, but they cannot accept it emotionally. So you must right size it for you. As I say, I'm happy with 100%. Doesn't bother me at all. And that is the only thing the only word of, caution if you want, but I would leave people with. And the only other thing I'll say, Rich, if I may, if you had a specific question that we didn't get to tonight,
Yep.
by all means, send that question in, and I will, if I have anything intelligent to say, I will certainly answer it individually.
Ditto, ditto. And the place to send that is info.asi@assetstrategies.com. And I'll share it with Brian, I'll share it with Adrian, and any of us can weigh in on that. The one thing I want to say, I'll make it 3 for 3. You need to go to the New Orleans Investment Conference for sure. Attend that event. We've been going, gosh, I've been going 20 plus years now. Michael, who's still very active in the company, by the way, he's traveling around the world right now. Been to the LBMA conference in Kyoto and went to Perth, and he's working his way through London back to us after a month of travel. So still very active. But Michael was at the very first one in the 70s, and either he or I or both of us have been at every single one. Okay.
Wow.
So the bottom line is you need to go. We don't go because we're idiots. We go because we know there's value there. And it'd be a great place to sit down and answer these questions we couldn't get to tonight. The takeaway I have for you, other than that, is what I said earlier. Don't hold up. Don't hesitate. Don't refrain from buying your gold and silver now. Okay. I don't want to bring Brian on for the fourth time when gold is higher and silver is even higher and try and get you to buy some. You need to take care of that business right now. We've got a dip. We've got a bit of a correction. These are to be embraced. Grab on tight, make the allocations in your portfolio make sense. Do it now. I think you'll be glad you did. The very last thing is, Brian, Adrian, thank you so much for a wonderful exchange. I think everybody got some value out of it, and I wish you and all of you listening to spend time next week with your family and friends. Have a wonderful, safe, happy Thanksgiving. We all have very much for which to be thankful. If you don't know what that is, just look at the gold and silver prices and the GDX, right? Thank you all.
Thank you,
Great
Rich.
night.
Thanks.
Thank you.